Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, well, it was another very volatile session. The S&P and the QQQs did end up higher, but it was not without a bit of turmoil all throughout the day. If you take a look at some of the price action here throughout the session, you'll see that we really had a nice pop very early in the morning. And then sadly, we gave it all back, and then people waited for the good old NVIDIA earnings. And they liked it. The market really liked it a lot. From the lows of the day to where we are right now in the after hours, you're about 1.66% higher on the S&P, and on the Qs from the lows of the day all the way up there, 2.33%, which does give us some very nice space into tomorrow's very big catalyst, which I'll remind you is the good old non-farm payrolls report for the month of September, whereby we get the labor participation rate, the actual jobs report, and the unemployment rate, which is everybody's biggest concern right now. And the NVIDIA earnings did a good job in terms of creating some space, lifting some optimism in the market. And it comes at a very big time in the markets right now, whereby people are extremely fearful. The extreme fear read is now still in play at about an 11. The last time we had this was during the massive tariff sell-off during the months of March and April. And it also, these earnings come at a big time as well in terms of how are fund managers feeling about all of this money that is being spent on the AI build out. If you take a look at this chart right here, you now have a record number of fund managers saying that companies are over-investing. And it's been the first time this has a very big print like this. The first time, guys, in about 20 years at this point, right? A majority of fund managers do believe that tech companies are spending too much money on AI. So there was a lot of pressure on NVIDIA earnings today. They did indeed deliver, but some people still just don't believe it at the current time. So in today's video, guys, we have a lot of things to talk about as per usual. Number one, we'll be going through those infamous NVIDIA earnings. Now, shout out to all the other companies that had earnings today, such as Palo Alto Networks and a few others. We'll be covering them tomorrow. Tomorrow we'll do Walmart, and we'll do a few that we missed out over the course of the week. I do want to take a look at perhaps Palo Alto that I missed tonight, and also perhaps a few companies from last week that you guys have been requesting, such as New Holdings and things like that. So we'll catch up on earnings tomorrow after the close and Friday. But today we'll focus a lot on the price action of the markets and on the NVIDIA earnings and how we are possibly set up into the jobs report tomorrow. So we'll take a look at NVIDIA earnings first. Thereafter, we will do a technical analysis rundown of the SPY, the QQQs, and our minor sectors. Check on the rotation and the market breadth. After we're done that, we will take a look at our big tech names, because some big tech names just keep moving down. It's not been a very easy landscape for them in the past few weeks. The NVIDIA earnings did ignite a lot of green in the after-hour session today, but that green can very easily be either unwound or added to tomorrow from the resulting jobs report, of course. So we'll take a look at our big tech list right here and derive. Even though we just had NVIDIA earnings, and even though we might have a jobs report tomorrow, fundamentally speaking, are some of these companies still good buys for a long-term portfolio, and or which ones could probably be some nice swing trades amidst this volatility? At the very end of the video, we'll be running through the biggest gainers and losers of the day list very quickly. Obviously, some of the biggest gainers in the after hours are all the names on the top of my list. You can't see the after hours move, but if I just pull up some of the charts really quickly to show you guys the extended hours, right? Names like APLD up 13%, CIFR, they're up like 15%, Iris Energy, CoreWeave, everything associated with the AI trade, names that have been underwater now for the past few weeks, getting some really nice lift. But as I said, tomorrow's jobs report, guys, is going to once again determine whether or not we can sustain the bullish price action, or whether or not we once again have to revise our outlook on the short-term macro of the economy, right? So we'll take a look at that list at the very end of the video. But for now, let's jump right into the first part. So in terms of the markets right now, the S&P up about 0.4% on the day, but look at the futures looking very good. The Qs up 0.6, futures market up an additional 1%. This does help create a lot of space off the lows here, guys. Off the lows of today, right? The jobs report would have to be pretty bad for us to unwind this entire move. 3.3% off the bottom on the Qs, and on the SPY right now, you're looking at a nice little space created of about 2.3%. So decent, but we are still in the context of a daily downtrend, bouncing into resistance on both the SPY and the QQQs as well, bouncing into a bit of a resistance range. So if the jobs report is bad, the bears do have a chance for a bit of a rebuttal to the downside, right? So keep that in mind. In terms of how you were looking on the heat map today, it was somewhat of a mixed market. Big tech did their best to kind of uphold the S&P and the Qs today, but the bottom half of the market still remains extremely mixed, right? Financials had a decent showing today. Some of the healthcare names, very few healthcare names, were some participating to the upside, but a majority of healthcare was consolidating today. They've been on a tremendous rally the past few weeks, so they do need a bit of a breather. And the bottom half of the market remains very mixed, right? Because it's the whole trade with the macro outlook in terms of your Fed rate cut in December. As you can see right now, the probabilities for a rate cut are at a very low 33%. So obviously that does not favor a lot of names in the bottom half of the market, names such as real estate, names such as some of the utilities, and also consumer defensives, right? Because those rate cuts do tend to stimulate consumer spending and consumer buying power. So anything closely tied into the consumer right now is still struggling. Moving on to the one-day relative, you can see how mixed of a day it was on the indexes. Tech, basic materials, communication services leading the rally to the upside. Shout out to financials as well, participating there too. But the bottom half, right? Energy, real estate, utilities, and consumer defensives, everything closely tied to the infamous potential rate cut in the month of December, sadly suffering. On your 1 week relative performance, everything is still underwater, sadly, as we are still in the context of a daily downtrend on the SPY, on the QQQs as well. If the job report is okay tomorrow, you might be able to see some of these groups turn around to the upside, but the damage so far has been done during the month of November. So just please keep that in mind, guys. It's very difficult to predict the markets and whether or not we're going to get the uptrends back. It all is going to depend on that infamous jobs report tomorrow morning to see if we can get some follow through from this AI bullishness in the after hours or not, right? So that being said, not enough information to make a clean stance on where the markets could be heading in the next few weeks. But depending on the jobs report, that will give us some good direction, whether or not we keep consolidating and find further price action levels to the downside, or whether or not the bulls have it in them to reverse this and move into some favorable November and December seasonality. It all relies on that jobs report tomorrow, because the rate cuts is something that a lot of sectors really desperately are looking forward to right now. And you cannot only lift the SPY with only big tech. That can only last for so long. You need more market breadth. And we know that market breadth recently has been quite soft, right? Percentage of stocks above their 20-day EMA, still very soft. Indeed, a buying opportunity in terms of historical context, but still, percentage of stocks in the S&P above their 20-day EMA only at 30%. You need more market breadth if you want to achieve new all-time highs. Percentage of stocks above their 50-day EMA also very low, 33%. Traditionally, a nice area for some buying opportunities, as history over the last few years does show it. I mean, not only last few, but the last 10, 15 years show us that it's a good buying opportunity. But I know the narratives are very confusing right now, and there's a lot of bearishness in terms of sentiment, of course, going around. And lastly, percentage of stocks above their 200-day EMA, well, that also is under the 50% mark. So unfortunately, only half of the S&P is above their longer-term moving averages. And you guys know how tough it is to lose the 200-day moving average. Usually, that means that companies are down 15, 20, 25% from local highs. And still, half of the market struggling to kind of keep it up as we continuously battle with the short-term bearish narratives that we've been highlighting on the channel now for the past few weeks versus your longer-term bullish tailwinds. It's just a very cloudy market environment right now overall. So that being said, let us move into the NVIDIA earnings and see, what does NVIDIA have to say about the allegations of the NVIDIA bubble? So let's pull up NVIDIA's earnings really quickly here, and we'll get into the numbers. So NVIDIA coming in with their earnings, and obviously you guys have seen the stock is up currently about 5.5% in the after hours today, and they desperately needed that as well, right? From the GTC conference, we rallied about 20%. Doesn't look like it, but it was a super fast rally from the bottom to the top, 20%. Then we gave it all back. We were sitting on support, and there was a lot of tension coming into today's report. Now getting a little bit of lift, sitting into the mid 190s. Definitely not a new all-time high, but also definitely not a poor performance by NVIDIA. They absolutely crushed it. Take a look here at EPS, beat by 3.52%, beat on revenue by 3.82%. That's not easy to do, guys, when you're making $55, $57 billion a quarter, right? Very strong earnings from NVIDIA. Take a look at some of the easy numbers really quickly here. Revenue was up 62% year over year. This is actually a re-acceleration of revenue. I'll show you that in a little bit. Their data center and AI revenue was up 66% per year. Also a re-acceleration in relation to the last few quarters. As you can see, the percentages here, guys, right? we're re-accelerating from Q2, which is the best place that NVIDIA can possibly be. Moving on to operating income, up 62% year over year. This company makes a tremendous amount of money, and earnings per share up 60% year over year. The biggest highlight, in my opinion, is the recapture of very high gross and operating margins. Operating margins a few quarters ago took a bit of a hit, but now we are back into the mid to high 60% range. More numbers from NVIDIA in terms of their guidance. That was the highlight of the current quarter, in my opinion. Their Q4 revenue guide was supposed to be $62 billion. That's what Wall Street had penciled in. The highest analysts on Wall Street had about 65, and that's exactly what the company gave, $65 billion in projected revenue for the upcoming quarter. Their guidance for gross margins staying very stable at 75. That's what they delivered this quarter. They'll be doing the same as well. And moving a little bit further here in terms of other lines of business, because yes, NVIDIA still has other lines of business. Gaming coming a little bit underwhelming here, 4.3 billion versus the 4.42 estimate. Professional visualization, a very small segment for them, but one that they did beat on, 0.76 billion versus the 0.61 estimate. And automotive, the infamous NVIDIA drive system that they've been making big pushes on in the most recent few quarters. They actually missed a little bit there by about, couple $million, call it about $30 million here, 0.59 billion versus the 0.62 estimate. Still very good growth rates year over year, right? But slightly missing the marks overall there. Other phenomenal numbers from the company, free cash flow, $22 billion in free cash flow. That is one of the best free cash flow metrics in the entire market right now. They did return $37 billion to shareholders in buybacks in the first 9 months of this year. And they also have remaining in the pipeline $62.2 billion of buybacks outstanding. Very strong numbers from NVIDIA. If you take a look at some of their some of the commentary here from Jensen came out at the gate, man, on the earnings call swinging. So take a look here at what they said during their earnings report. Blackwell sales are off the charts and cloud GPUs are sold out. Shouldn't come as a surprise. He's been telling us that for the last 3 quarters. Compute demand keeps accelerating and compounding across training and inference, each growing exponentially. We've entered the virtuous cycle of AI. The AI ecosystem is scaling fast with more new foundation model makers, more AI startups across more industries, and in more countries. AI is going everywhere, doing everything, and all at once. Moving on further to some of the NVIDIA highlights here from their lines of business. You can see data center, obviously the big growth driver behind the company. But gaming, not doing too bad, slightly underwhelming versus last quarter, but definitely a very nice step up in relation to the last few years where gaming was a bit soft for them and AMD as well. Visualization, small segment, but still nice to see them putting in some gains year over year and quarter over quarter. The automobile division will be scaling rapidly in the future, but is still quite a small version or a small line of business for the company. But all lines of business performing very well. The data center is really where it's at. And if you want this chart visualized, don't worry, guys, I got you. Here is the NVIDIA revenue breakdown. You can see they don't make that much from their visualization, auto, and OEM segments, although they are growing those into the future. Now it's still a very small component, but still a very healthy $1.6 billion. Gaming, 4.3. But look at the data center acceleration, guys. This was a concern. Coming into the end of 2025 and early 2026, was NVIDIA going to slow down, or was it going to keep full steam ahead, right? Then, as a matter of fact, they are not only keeping full steam ahead, but accelerating the revenue growth profile as well. As a matter of fact, on the conference call, you might remember that during the GTC conference, they gave $500 billion of revenue guidance for the next 6 quarters, which is a big increase versus the prior estimates. When asked about this on the earnings call, the CFO said, you know what? It may be even more. There is an opportunity for more than $600 billion in the next 6 quarters. So maybe that guidance was even a little bit light. Moving on to further things from NVIDIA, Jensen kind of shouting out to Michael Burry and the people who have problems with the depreciation schedules that a lot of big tech is using right now. Jensen coming out and saying the A100 GPUs that we shipped 6 years ago are still running at full utilization today, powered by vastly improved software stacks. So, kind of referencing the fact that, yes, you can indeed use a 5 to 6 year depreciation cycle. It does make sense if you are still using the chips for various things. Obviously, the fastest chips can be used for training. Some of the more outdated chips can still be used for inference as well. So they do still have a useful life beyond the traditional 2-3 years, which is what everybody has kind of been hinting at, right? Overall, though, guys, very solid quarter by NVIDIA. If you take a look down here as well at their balance sheet. Let me just run it down real quickly right here. Let me just go to... Let me just try to find it here for you guys. I don't want to spend forever on this. There you go. Cash and marketable securities, $60.6 billion. Accounts receivable was stepped up, and some people on Twitter seem to be having a problem with this. Very normal accounting, in my humble opinion. $19.7 billion in inventory, stepping it up with the growth of their revenue. These inventories are obviously recorded now, but will be shipped out in the next few quarters as well, and they are proportional. The goal is to find whether or not all of this stuff is proportional to the increases in revenue and increases of backlogs, and that is the case for NVIDIA. I know a lot of people are trying to break this down and trying to spin it XYZ fashion, but this is fairly normal and standard accounting, in my humble opinion at least. So the final segment here on NVIDIA, now that the stock is up to $195 after the close, is NVIDIA a buy? Well, we can talk about the fundamentals, but we can also talk about the sentiment. First, let's talk about the fundamentals here. At $195 in terms of their forward 2026 price to earnings ratio, you are under 30, 28.55. Not much of a bubble there if you look at price to earnings. Now, price to sales is quite high at 15.4. That I will agree with. But in terms of just natural earnings and free cash flow, it's actually not that bad. It gives them a PEG ratio moving forward of 1.24. And I went kind of light on the EPS growth estimates. Some analysts are higher, some analysts are a bit lower. The range is between 20 and 25%. I casually took a midpoint of the estimates right here at 23. That being said, you would be sitting right now at a 1.24 PEG. So NVIDIA, objectively speaking, is cheap. But some of you guys are not going to be convinced of that, right? So right now, I could talk to you all I want about how nicely NVIDIA performed this most recent quarter, about the big opportunities in the future, but a lot of people are going to still focus on the depreciation cycle, whether it makes sense, the circular financing between NVIDIA, OpenAI, Microsoft, CoreWeave, and all those companies. You guys remember the infamous chart. And some of you guys, quite honestly, are just not going to be convinced no matter which statistics you see, because you are just not convinced that AI is as revolutionary as people make it seem, right? Or maybe you just want to see more proof overall, right? The fact that all these companies are spending hundreds of billions of dollars, almost trillions of dollars on this data center build out, and you may not be convinced that they're going to be able to generate sufficient ROI on that spend. That is perfectly normal, guys. But if you want my opinion, so NVIDIA, in my opinion, if you believe in AI and you believe in this company, NVIDIA indeed is still an attractive buy location right now. I know, and I'm even saying that at $4.53 trillion in market cap, NVIDIA, although not an extremely cheap company, is still manageable in terms of valuation. We can still see some further upside if you are just focused on the numbers alone, their free cash flow generation, their earnings per share generation, et cetera, et cetera, et cetera, right? That being said, guys, if you want my humble opinion on the whole debate of whether or not we're in an AI bubble or not, right? I'll be very honest with you. The bulls have very logical and very good points. The bears also have very logical and very good points. But you should really do your own research, guys, and determine which camp you're sitting in. My opinion right now is that we are sitting on an inflection point, okay? The people that are not convinced about AI arguably will never be convinced, and that is fine. If you are in that camp, that is your opinion, and I perfectly respect that, and you probably would not want to play these companies, and maybe you're even scaling back your bets on big tech because you don't enjoy the capital-heavy structure that they're embarking on. Big tech used to be a very easy trade because not only did they have very large moats, very large competitive advantages, but additionally, they were very capital-light businesses, using most of their free cash flow to just buy back shares endlessly. And people are able to get behind big tech as that type of trade. I do agree that that has since changed. These companies have moved from capital-light businesses to capital-intensive, capital-heavy businesses that are investing in the future for AI. AI will have very real-world applications, whether production line focused in terms of efficiency gains, machinery gains, robotics gains, gains in healthcare as well for determining various treatments without actually having to test things in real time. We can now model them. So AI does definitely have its place in society. Is it going to replace some of the labor workforce, that some of the white collar jobs, some of the programming jobs that you guys might have gotten used to over the last 10, 15, 20 years? Yes, absolutely, right? So the future for AI is definitely real, but you just may not agree with how much money these companies are spending now in order to execute that build out. So the final conclusion is it's an inflection point, guys, okay? It is an inflection point. If you are a firm believer that AI is going to transform the world in the next 5-10 years, then you would definitely stay invested in these companies. And the bearish thesis, although very valid, right, will come in waves. These companies will not move up in a straight line. It may be a bumpy journey, but you should arguably be holding if that is your thesis. Don't get shaken out, right? If that is your thesis, stick with it. If you are not a believer in AI or you believe that these companies are spending too much, this is your inflection point, right? With what we just had tonight with NVIDIA earnings, okay? This is when you pretty much draw the line, whether you want to be in this trade or out. I can't make that determination for you. It depends on your risk tolerance. It depends on your thesis. If you do not enjoy the AI trade, there is a whole host of companies in the S&P 500 that have very real business models that just have not performed well at all this year. Industrial companies, consumer staple companies, other consumer-facing companies, and other technology companies that just have not spent that amount of money on CapEx for AI. That is completely up to you. I can't click the buttons in your account for you, and I'm not going to sit here and try to convince you or to try and sway you either direction. That is something that with all relevant information that you have to come to that conclusion. Myself personally, am I changing any of my allocations? No. Do I believe in the AI thesis? Yes. Do I believe that some of these companies might have overextended their spend initially and could only see production gains in the next 3 to 5 years instead of the next 6 to 9 months? Yes, absolutely. But I'm willing to withstand that volatility because I am going for the longer term 5 to 10 year thesis overall. Maybe we'll be correct. Maybe we won't, but that is going to be my choice. And as a result, those are the positions that I'm going to keep in my account. Yes, I will be buying more NVIDIA. Yes, I will be holding NVIDIA. Yes, I will be holding all the other hyperscaler companies that I've held in my portfolio for almost 10 years right now, because I do believe that although these companies are spending a lot of money right now, they also have a tremendous amount of research put into all this stuff. In my opinion, these companies are not stupid, guys. Yes, they're spending a lot of money, but I don't believe they would just be lighting money on fire, as some people currently are alleging, right? You could argue they could have spread out the CapEx a little bit better, but it's a race right now in terms of AI, right? And they want to get those data centers built. We will see if there's going to be an energy bottleneck late into 2026. That would be my biggest concern. My concern is not, though, that AI is just going to be a fad or something like that. It is something that you guys will all have to prepare for and deal with over the next 2, 3, 5, 10 years, because that is where we're moving towards. And that is my entire segment, both fundamentally for NVIDIA, but also psychologically in terms of this narrative, right? It's not a very easy narrative. There's a lot of noise, right? So just find your lane and position accordingly per your risk tolerance. Don't get swayed either direction, guys. You guys know what's best for you in relation to your goals, your risk tolerance, and your portfolios. So get to work, and wishing you guys the best of luck and success in all your different trades or investments, whether you're in AI or not. That is perfectly fine. There's many ways to trade the markets, obviously, and invest in the markets as well. Moving on into our second segment, which is going to be our index rundown here. Moving into the S&P. So the S&P 500 will have a bit of a challenge tomorrow, and it's going to be this one, the jobs creation softening, right? So we will see if the non-farm payrolls comes out better than expected or worse. But the one thing that we do know for sure right now is that we have created a decent amount of space off the lows. I will use the futures chart just to give you guys an idea of how much space in terms of the retracement size, right? Right now, you have a decent size bounce going for us. It's a 50% bounce. But you remember the last time we talked about these bounces, a bounce is only a bounce, such as this one was, a 80% bounce, until you can actually change the trend, right? So if jobs report comes in negative tomorrow and we reject from this resistance range, you will be coming right back down to your lows, line in the sand, 657 roughly on the good old S&P 500. So if you do fall a little bit lower, I'll jump back to my S&P chart. You are going to head to the lower area of resistance, which will be closer to the 26 EMA, the China tariff fear lows as well. And that location is about 650. Down about 645. This little pocket should be the next support area overall for the markets, and we will just have to take it one day at a time. I'm not going to sit here and try and predict what's going to happen tomorrow, but at least the bulls have created an absolute ton of space on the S&P 500, guys, to absorb a possible weaker than expected jobs report and for people to possibly attempt to reverse this trend. Obviously, if the jobs report comes in somewhat favorable versus the expectations, because the expectations right now are quite low, right? Very low. If we get a better size bounce right now and reclaim support, that's going to better our odds of being able to reclaim these indexes. I would not blame you guys if you want to wait to position until, well, maybe until after the jobs report, that's for sure, right? Because we're already the evening. I mean, it's coming out before the market open tomorrow, right? But I would not blame you if ever the markets dump tomorrow after the jobs report. I would not blame you to wait to position on these indexes and in these markets until you recapture a daily uptrend, because we know trading, especially trading, is a lot easier when you have a confirmed daily uptrend and there isn't some of these bearish narratives at play. If you guys just want to wait on the sidelines and wait until all the flushes are possibly complete, wait until we get all that stuff out of the way, possibly wait until the December rate cut, whether or not it's going to be a confirmed fact, that's perfectly fine. You're free to do that. Arguably, especially if you're trading, it might just be better in terms of waiting for the daily uptrend to be confirmed rather than kind of getting faked out, right, by these lower highs overall. Moving on to the Qs right now, same analysis stands on the Qs. Daily downtrend is underway. We were bouncing into support 595 down to 590, which were the China tariff fear lows. Overall, right now, we've created a ton of space, but once again, this is only a lower high. Lower high coming right into resistance, as you can see right here on the futures market. If the jobs report is bad, we will most likely come back and try and retest these lows. We do have a lot of space right now, but a bounce is only a bounce until you change the trend, right? It is a nice 50+% bounce from the highs to the lows. Nice little bounce right now, but it's not confirmed at all. So I cannot sit here and tell you guys that, yeah, we're going to make our way back to the all-time highs. No. You have to change the trend to be certain that your weekly higher lows are in, that you're not in for more weekly and or monthly consolidation as well, something that the markets have not done in the last 6-7 months. It's notable to us right now, guys, because this is the first time in 6-7 months that we've lost the daily uptrends, right? So it has to be notable to you that this time indeed is different and you might just have a bit more volatility on the table. But like I said, the jobs report tomorrow is probably going to move the markets in a big fashion. So just pay attention to your levels overall. And if you want to be patient and wait for a new confirmed daily uptrend before committing to some swing trades, especially longs, I would not blame you. It might just be the more cautious way of playing things for most people out there. Moving on to financials right now, bouncing off the 200-day EMA at 51.25. Big engulfing move by the bears. This is another section of the market whereby I wouldn't blame you if you want to have a daily uptrend recaptured before playing some of your favorite financials names, right? Because right now, it's just full bear control of this chart into support, and our support level stays put at 52, down about $50. Weekly downtrend, and as a result, a monthly consolidation period of time for financials. No secret here. The reason being is these low rate cut odds for the month of December, right? Now, there's a silver lining in this because the odds are so low, right? I mean, the Fed can either be worried about inflation, but you know what's funny about the Fed's worries about inflation? They literally just put out a chart 2 days ago. This is from the San Francisco Fed, where they did a case study, or rather a study of the data for the last 150 years. And they determined that the impact on inflation from tariffs actually did not have any meaningful impact whatsoever. If anything, inflation actually trended down. You saw some initial pops, but it trended down, which is what is in line with what Jerome Powell's been saying for the past 2-3 months. However, what it did impact, though, was the labor market, right? So the labor market took a little bit of a hit as obviously companies are forced to somehow raise prices, and obviously consumer spending towards those companies goes a little bit down. So their own study shows exactly what they've been saying. The balance of risks in a tariff environment shifts from one of inflation, at least structural long-term inflation, towards unemployment. So you would expect the Fed, if they were following their own data, that they indeed would need to cut, but that's not the speech. That's not what the speeches that's not what certain Fed members have been saying over the course of the past week. A lot of your Fed members are very divided right now as to whether or not they should do a rate cut in the month of December. But if they were to follow their own data, they should be cutting. And I'll remind you, the Trueflation Index right now is sitting at about 2.42%. This is a better gauge than PCE or CPI because this measures 15 to 17 million different products every single day by SKU. So this is a real-time update of a very wide basket of consumer goods. So keep that in mind. But financials, they're struggling because of the low rate cut odds right now. So we'll be looking to establish some form of a monthly higher low before maybe resuming trend higher. The banks and a lot of other companies, guys, have gotten crushed in the past few weeks. Right? Like JP Morgan, 3 weeks of upside, undone in 3 days since the government reopening and the lack of data and the threats about tariff inflation and things of that nature, right? So the banks have been selling off in a big way. Visa and MasterCard, despite posting really strong earnings, lost some of their levels. You can see Visa challenging the 320 area down here, MasterCard challenging the 530 area down here. These companies have sacrificed all of their gains from the entire year so far. So a lot of that damage accelerated in the last 4 days since the government reopening overall. So financials is going to need more clarity on the rate cuts to come in the month of December, possibly, before finding a local bottom. But if you also wanted to wait until a clean new daily uptrend is established to structure some longs, I would not blame you either, right? Notice how we're waiting for confirmation. I'm not trying to predict whether this is the bottom of the Qs, the bottom of the SPY, the bottom of XLF. I'm just saying, if you want to have the best success rate for a lot of your uptrends and have local tradable bottoms, wait for the daily uptrends to be back in motion, and you might just have better success in your trades. Moving on to healthcare right now, 0.17% to the downside, hovering around here, not doing much of anything. Line in the sand, 151.22. Cracked this to the downside, daily downtrend, and as a result, weekly consolidation. This chart would look beautiful for a bit of a backtest trade, right? If you come back down here, 148 to 145, the moving averages are curling up. Previous big resistance should now be support for the markets. Took the bulls a while to get through this one, right? And now if we curl back into it, it might just provide new entry opportunities. The monthly time frame on healthcare still looks pretty good right now. Full engulfing move. This would pretty much just be a nice cup and handle if they pull back into there. So pay attention to that. A bit late to position in healthcare right now, in my opinion, for some swing trade longs. Monthly MACD is nice. So if they give us a bit of a pullback, I will be a fan of playing healthcare once again. Moving on to semiconductors. Semiconductors up 1.85% during regular hours, but in the after hours, flying higher, right? Beautiful new hourly uptrend. 350 is currently where we stand. So on the daily chart, 350 is all the way up here. That is still a lower high for now, right? So they have to confirm the daily trend change if you want to have better luck in positioning for some swing trade longs, rather than saying, yeah, that's the absolute bottom. NVIDIA saved us. Positioning, right, too early, or rather after a unfavorable jobs report, you put too much credence in the NVIDIA bullishness, right? You try to go for this and you just get unwound. You may as well just wait for a confirmed daily uptrend, because until that happens, you are still in weekly consolidation and still arguably in monthly consolidation too, which could send us a bit lower. If the jobs report is bad and the markets keep flushing, you're going for the 12 EMA backtest, probably across the board, guys. On the SPY, which is significantly lower, on the Qs, which is also significantly lower, and especially on semiconductors, which is significantly lower. So keep that in mind. Until we reclaim the trends, it's very tough to say that this indeed is the market bottom and that we're just going to rally through the end of the year as if nothing happened. You got to wait for the trends, man. Moving on to the Russell right now. The Russell down about 0.02%. This one clear and clean daily downtrend into support, into where? Through 232, down about 226. This whole like 5-6 point range, which is the previous highs from 2021. Resistance here, resistance there as well. And now current support for the markets too. Weekly uptrend was unwound, of course. So now just consolidation and monthly consolidation too. These weeklies take a while to get back, right? This monthly consolidation also takes a while. So if we're looking for some positioning here, this is a no recession thesis, guys, right? If you guys are on the fence, whether or not you're going to have an unemployment recession, or whether or not consumer discretionary spending comes back, or whether or not the Fed is too late in cutting interest rates, you're not going to want to bid the Russell, right? This trade is only for the people that have a no recession thesis, and that interest rates will provide nice opportunities for a lot of the growth names in the Russell overall, right? So it's a very polarizing trade. People will stay divided. Do not force yourself to play this one if you are not feeling it or if you do not believe in that type of a thesis, right? Moving on to some of the other names here. Take a look at the VIX real quick. We're not going to go over yields because yields just move all over the place tomorrow with the jobs report, right? Moving on to the VIX right now. The VIX, not terrible, 24, 25. We popped up early this morning, and then we kind of came back a little bit here. So depends on the jobs report, right? Jobs report goes not well tomorrow morning. The VIX is going to skyrocket. It is going to be a nice opportunity to continue to sell covered calls on some of your positions if you are somehow underwater, to just farm some premium on some of your growth names perhaps, or selling puts under the market on some of your favorite names. Do not force yourself to play companies that are not your favorite names. Too often I see people forcing themselves to play companies like this, the APLDs of the world, the Iris Energies, the CoreWeaves, the NBISs, the BMNRs, just because they're down a lot. If you guys are not a fan of these plays, only focus on selling put options on companies you actually want to own at those strike prices, right? Of which there are many great opportunities in the market to be selling puts on, and you do not need to be too close. That's what the VIX allows us to do. When the VIX is high, it allows us to sell put options way below the market, guys, while still collecting very decent ROI. I was looking on Amazon's drop this morning with the high VIX, right? Amazon, we could find some low 200s puts, right? And that's just Amazon, but you can find so many high quality companies that posted great earnings that you can sell some puts on potentially way below the market if that is your style of trading. So focus on your highest quality, highest conviction stocks, because at the end of the day, if you get assigned, man, you're the one holding the bag. And the last thing you want to do is hold the bag of a bunch of volatile stuff that other people told you that they were playing, but that you didn't really want to play, but you kind of just followed the trend just because it was fun at the time, right? Consolidation is very severe on some of those names sometimes, so keep that in mind. Moving now on to gold. So gold, not too bad of a day on gold, but a bit of a flat day on the Wednesday session. So if you take a look right here, the bulls are still trying to go for the expansion out of this range. They have the daily uptrend. They're trying to go for it, right? But if you break down below 39.90, it's another daily downtrend and perhaps just extension of weekly consolidation overall. Maybe gold just has to go into a tightening up cycle, just as it did right there, right? The 12 EMA is definitely catching up. It still looks okay for a bull break long to the upside here, but, you know, there's a lot of moving parts to this gold trade, so just pay attention to it overall. The daily bulls are still in control of this one for now. The weekly bulls are still also making an attempt at moving higher, right? The line in the sand stop loss for any longs needs to be below here, 3,900. Break 3,900. It's a weekly downtrend and the start of possible further monthly consolidation, which might bring you down, you know, 37, 3,600 as we wait for this 12 EMA to kind of curl up to the price. Moving on to Bitcoin right now. Bitcoin, not too bad. I mean, today, Bitcoin was down tremendously, like 4% coming into the 88,000 level. And after NVIDIA, you know, even though Bitcoin arguably has nothing to do, but it's a risk on sentiment trade, right? So obviously when people are piling back into risk on trades in the after hours after the NVIDIA earnings, you're going to get a little bit of bids here from Bitcoin. So Bitcoin's saving the lows for now, but would we be able to call this a bottom? We can't call it a bottom, guys. It's a daily downtrend. The bears are in full control. Yes, we're daily oversold. Yes, we have a nice bounce, right? But similar to other times, are we just going for a lower high on a weak bounce and then further flush? You don't know. So before positioning for some swing trade longs, perhaps most of you may just want to wait for a daily uptrend confirmation. When you get the daily uptrend break, you can put a stop loss below there, and then you go for the weekly expansion back up here and possibly some monthly expansion in this cycle too. I'm not going to call it crypto winter. I'm not going to call it the end of a 4-year cycle, guys. Not just yet. We are bouncing into support overall right now. We are currently sitting at 94 down to about 87 area of support. And the same thing goes for Ethereum. Ethereum also, the context is still a big sweeping daily downtrend, right? Pay attention to this daily downtrend. Can we call it an Ethereum bottom here? Is this the bottom of the overall sell-off? It's very tough to make that determination, especially when we cannot get back something as simple as a daily uptrend in the context of a big weekly downtrend as well, and in the context of big monthly consolidation. If you have a long-term portfolio and you believe in the long-term thesis for Ethereum, this is a nice nibble and DCA area for you. But for those of you that are looking to pick the absolute bottom with massive call option positions, right? Just be careful, man, because unless you have a daily uptrend, it's very tough to just commit to a position here and just say, well, I'll just put my stop loss down there and I'll just take my chance. Trading longs without confirmation, guys, is always a very risky proposition. So just be careful with your position sizing if you're trying to call this as the bottom, right? Now, that's it for our overall market rundown. Let's dive into big tech really quick. So first, moving into Apple, let me move myself over. Apple, not too bad, guys, but still struggling to maintain these 267 lows right now, right? I'm not going to give it to the bears really quickly because these are relatively equal lows. If Apple somehow goes down after the jobs report, you have lost your daily uptrend and you will be heading into weekly consolidation. The structural level to pay attention to after that will be the retest of prior all-time highs and the 12 EMA around 255. That will be a next area that I would be interested in taking some swing trades, provided that the price action is not too bad, as Apple is extended on the weekly and even on the monthly timeframes too. So we do need a bit of a pullback to fire off some more swing trades, in my opinion. Apple, for me, long-term portfolio is a hold. It's not a buy. It's not a sell up here. It is a hold. They should be having a good Q4. That was their guidance. The valuation, though, a little bit high to further position Apple shares up here, which is why I'm not so interested. Moving on to AMD. AMD was down 2.93% during regular session, but up huge after those NVIDIA earnings from these market closing prices, right? Absolutely up right now, 5% in the after hours, but we'll see, man. The jobs report is going to be huge for so many of these companies because right now, AMD, man, they broke structure. That is a daily downtrend, and also further weekly consolidation for this stock. Next stock is the 12 EMA right here at about 212, and beyond that, you would have to come back to $200 psychological to probably find a lot of buyers right there. You are in the context right now of the beginning of monthly consolidation. It can last. If the jobs report is bad, we will unwind a lot of those NVIDIA gains, and AMD can shave a little bit more off the table as well. Very tough to position for short-term longs on AMD. Long-term positions, sure, the thesis still makes sense as part of the AI trade. Around 240 where it was at a 38 forward price to earnings, a very low 1.09 peg, which now 10% lower is going to be closer to a 1 peg and closer to a 9 forward price to sales. Not bad numbers for AMD, but these long-term shares that you may acquire from here as we move through further consolidation, guys, you got to keep in mind, if you're in AMD, you're in it for the long term. The short-term price action is going to be very volatile. But if your thesis is expansion into 2026, 27, 28, then buying shares here does make sense. If you do not believe in the AI thesis, if you do not believe in in AMD's ability to execute on their growth projections, then it would not be the stock for you. Moving on to Amazon right now. So Amazon down, or rather, sorry, it was down, but they closed green. Amazon was down like another 2% during the day, bouncing very close to the 200-day EMA and very close to support, which is arguably 220 down about here, about the 210, 211 range overall. It's the area that the bulls previously defended for the last few months overall. Full unwind of your earnings. Unfortunate for Amazon, but many other companies have been kind of just put through the washing machine, right? From the top of earnings to now where we are, 15% discount on Amazon. That's after posting ridiculously strong earnings. Amazon at 230 right now is not even that bad of a buy, under a 34 price earnings, about a mid 1.5 peg right there. And all lines of business, whether advertising, cloud, e-commerce, all of their divisions, guys, Amazon Prime Video, we could talk about their pharmaceutical business, we could talk about so many other lines of business that Amazon has. They're all doing really well, but unfortunately, the share price just suffering because of short-term market sentiment right now. In my opinion, guys, even though we've sacrificed most of this weekly push and sadly given back the support range as well, 240 down to about 230, it is still a nice buying opportunity. I am selling some put options on Amazon down below in this range, 215, 210, and possibly lower, depending on how aggressive you want to be. I think it's a good opportunity to pick up some Amazon shares through the wheel, or maybe just nibble at some Amazon shares. If you believe in the expansion of this company through 26, 27, 28, right? Because their revenue and EPS growth numbers are very solid. Still one of my favorite opportunities in the market, but I know it sucks sentiment-wise when you go up so much, you round trip absolutely everything. You can feel a little bit defeated, absolutely normal. But when you do feel that way, just remember what company you actually own and the direction the company is actually moving towards. Has anything changed with Amazon's business in the past 2 weeks? Not at all. That's what you should be focusing on right now. Moving on to Google right now. Google up 3%. They were up as much as almost 7% during the day after the release of Gemini 3 was really well received by the market overall. And now sadly right back into the high. So unfortunately Google unable to break and close above the infamous $300 price range. We are now back trapped between this range, the highs where we are right now, 293 down to the lows of about 271. In the after hours, NVIDIA did give Google a little bit of, support in terms of just a sympathy play, of course, right? So we will see. But as I said, the jobs report tomorrow could unwind all this bullishness, and you can find yourself back down below here. In my opinion, guys, you're going to have to get a break and close above this support range right now because the short-term trend is all over the place, and even medium-term, right? Google's trying its best to push on these weeklies, but the weekly timeframes are very, very much overbought. So in terms of a short-term swing trade, you guys already know it's very tough to go for a swing trade long up here. It's extremely greedy. In terms of some longer-term shares, that might make a little bit more sense. If Google pulls back like Amazon did or something like that from here through the 250s, it is a long-term DCA for my portfolio, in my opinion, as at 290 or lower, the forward metrics in terms of price to earnings and PEG ratio are still quite manageable. Moving on to Meta right now. Meta down about 1.23%. Another fantastic opportunity in the markets. However, some of you may just not like it, right? You may not like what Mark Zuckerberg is doing with the either capital expense profile or the overall operating expense profile. And that is completely fine. That is your opinion. If you do not want to buy Meta down here, then just don't touch it, right? For everybody else who is interested, the valuation down here is somewhat compelling, right? Under 630, especially at 590, 5% lower than that, you're at a 20 forward priced earnings, a quite manageable PEG ratio as well. And the free cash flow yield is kind of trickling up a little bit as we kind of move up into there. That being said, the short-term trend, you can clearly tell who's in control, right? It is the bears. Big sweeping weekly downtrend. The daily is still a downtrend. So for you guys, short-term swing trading, it's tough. And I've been saying this since here, right? It's tough to call this a bottom, isn't it? Without a uptrend confirmation. You're much better off waiting for the uptrend confirmation so you can actually know that you have a somewhat of a tradable bottom that you can kind of base your trades off of, right? So Meta deeply oversold still at this current time. The last time they were this oversold was during tariffs or during the big old bear market of, my chart can scroll back. I'm scrolling too fast. 2022 overall for Meta. So good long-term buying opportunity, but short-term swing trading can still be very choppy. Moving on to good old Microsoft here. Microsoft down 1.35%, clear break on the daily downtrend. In the after hours from the NVIDIA earnings, we have a bit of a recapture here from today's trade back up to 493. But one thing's for sure, man, the bears are in control of this. And now this box, which I will not close red until this weekly candle closes, is acting as big resistance. If the job support is good and Microsoft can come back into support, well, we will tackle that when we come to it. But as of right now, they're working against, a lot of support up here, a lot of resistance. 520 down to about 500 is the resistance range. Daily downtrend for now, weekly consolidation for now as well, and at the same time, monthly consolidation. We are very close to my, ideal buying opportunity, which is the 12 EMA 475. So we got close to it today, right? We got down to like 482. Not that bad. So a little bit more, and I will be adding a few more Microsoft shares overall. I've been nibbling at Microsoft in around the 500 range, but my buys start to get a little bit heavier as you move to the 12 or below the 12, especially down to this pocket. Ideal pocket on Microsoft, 475 down to 450 for some long-term portfolio adds. Just healthy monthly consolidation, in my opinion. And at those valuations, at those prices, the valuation is a bit more manageable. You would just take 10% off of these ratios, closer to a 30 forward PE, closer to a 1.75 PEG. Moving on to Netflix right now. Netflix, the stock that just had a 10-for-1 split the other day. It's been very volatile. Yesterday, huge day of upside. Today, not so much, giving back all the gains. So very choppy, but this resistance range is no joke. 116 down to about 112 is the resistance range. It was an area that the bulls defended for quite some time, guys, and now we've lost it. We're also playing around with this 200-day EMA. The weekly time frame shows a more clear picture. It is still a weekly downtrend. The bears got a back test here, and you may just be looking for a little bit lower if ever the markets unravel a little bit more. So short-term swing trades, as I always say, man, you don't get the daily uptrend. It's tough to kind of create some of those swing trade opportunities, but long-term portfolios, right, looking quite good right now, around the $110 mark. We're currently trading at about a 34 forward priced earnings, a 1.7 PEG as well, and very good earnings from the company recently, and quite good guidance as well. So I am nibbling some Netflix shares and some leap call options from the 110 area down about the mid-90s. This little pocket is the pocket that I want to build some longer term trades, whether leap call options or some longer term shares. But you guys are noticing a common theme across the board here, right? None of these names so far have qualified for short-term swing trades. Why? Because they are in daily downtrends potentially, or overextended like Apple and Google. And additionally, we do not have the correct direction on the indexes. We do not have the daily uptrend. So as a result, recently, I haven't been going for any short-term swing trades, but long-term positions for long-term portfolios and longer-term leap call options with a lot of time on them. Those are the only two things that make sense to me right now. Moving on to NVIDIA. So NVIDIA, obviously, we just covered them for their earnings. They're sitting about 195 in the after hours right now. Same concept. Nice bounce, but you got to give me the trend change, right? Even if we fully engulf this move. It's a nice bounce, but if you just unravel with the job support tomorrow and go right back down here, you're just stuck in this big consolidation phase for the stock. Support stays put 185 down to 178, which will be a nice longer term buying opportunity, but very tough, guys, to go all in on NVIDIA for some short-term call options or things like that without them confirming a sizable daily uptrend, right? Weekly was still in consolidation. We have not lost the weekly lows, and monthly also was in a bit of consolidation, but now we're kind of just stuck in the middle right here. So NVIDIA for me right now is either two different trades, either adding shares to the long-term portfolios or a greedier trade. I'm not saying it's going to be a 100% success ratio trade, but there is a thesis for building some leap call options, not too heavily, right? But some leap call options, December 2027, and you go for the expansion, the re-expansion, or I guess rekindling of the bullish thesis behind the AI narrative, right? Just don't go too heavy on this because it's not an optimal entry. Optimal entry is always the 12 EMA for leap call options on some of these names. Moving on to Tesla right now. Tesla up about 0.68%. Not too bad of a day for Tesla, but still struggling down here to support. 405 down about 383. Daily downtrend, full control, right? So all of these trends, you remember we were looking for the breakouts. The trends were logical. They made sense. We could establish nice stop losses going for the breakouts. Now, what are we doing down here on a lot of these charts, right? You were just assuming that this is a bottom. In the context of a daily downtrend, in the context of a weekly downtrend, it doesn't really make sense, right? You need the trends back, guys. Right now, it's weekly downtrend and monthly consolidation as well. The best possible location for, structure to support us if we fall through here with the job support is going to be 360 down about 340. You got a lot more price action down there overall, and it would be a pretty healthy retracement size, by the bears. So overall, Tesla as well, right? Tesla is a tough name to get behind if you don't believe in the long-term positives. A lot of people focus on the short-term negatives, and that's fine. I get it, right? But if we're looking for the long-term positives, where I would feel more comfortable, maybe adding or nibbling for some shares, might be down here in the mid 300s. And I do realize the valuation is expensive. That is true in the short term, but if you believe in the long-term positives, you can justify the valuations here, even at 350. It just depends which camp you are in. Moving on to Palantir. Palantir down 1.14%. This one as well in the context of a daily downtrend below support, which is 185 to 170. If they close the week below here, I will have to change this box into a big area of resistance. For now, we are also losing the weekly uptrend, right? If you get a close below here, your weekly uptrend is lost. You give the bears a chance for the weekly downtrend, which we have not had since the tariff situation. And also you open up the door for further monthly consolidation, possibly will extend us down into here, the 150, 140 range. I know some Palantir shareholders don't want to hear that, but I'm a Palantir shareholder myself, guys, right? And if it has to happen, it will happen. These monthly consolidation phases are very normal for every single stock in the market. So just pay attention to the levels and how we close this week. It's going to be a big week for a lot of the structure in terms of the price action for a lot of these names. SOFI also hovering around their more recent lows down here at about 26.72. It was up about 2% on the day. Not too bad, but now this entire area above us is resistance 30, down about 28.5. Decent area though for a couple different things. It's super choppy, guys. So being able to call this the bottom for a swing trade long, super choppy, right? Not the best trade or not the best clarity, in my opinion, for short-term swing trades. The way that I'm trading SOFI, selling put options down here, 25 to 22. I would not mind owning the stock down there. Even if we flush this, right, and give back some levels and go into monthly consolidation, it would look all too natural, just like Palantir, just like a number of other names that we covered today, right? So 25 to 22 is the area that I'm targeting right now. At 27, you're looking at a forward PE of about 45. EPS growth rate on average for the next couple of years is very good. A lot of that is in the first few years, and then it will be tapering back. So if you want to use price to sales, you can use price to sales as well. At 7.3% for a fast-growing company, I do not believe that this is an egregious price to sales metric for 2026. And if it comes down here at 25 to 22, it's going to be even better. And the technical entry will also be very good as well. So that's when you'll find confluence between the technicals and the fundamentals, which is something that I've been focusing on recently, guys. Because, recently there's so many names in the market that were either one of two things, right? A great technical setup, but not good fundamentals wise. A good fundamental setup, but good technicals wise. Our job, if we want to find the best possible swing trades, whether short, medium, or long term, is to find charts and find companies whereby the technical locations for pullbacks line up with a good fundamental valuation as well. That's when you know that you have the most odds in your favor of the thesis playing out, right? But at the end of the day, it's never fully confirmation there's never fully 100% confirmation, right? It's just you increase the odds of your trade thesis playing out. Moving on to Uber right now. Uber closing below the lows, unfortunately. They got a little bit of love from the NVIDIA push, but not much, right? So you can clearly see what we've been talking about and worried about the last few days, right? Which is the daily downtrend break below support. We're getting it now. 93 down to 90 was support. And now we might just be looking to kind of break down and fall further into weekly downtrending territory. And as a result, monthly consolidation, right? Monthly consolidation across so many names in this list, the indexes, a lot of our growth names as well. Monthly consolidation is part of the game, guys. They have to do it, right? And right now, my favorite zone for Uber is going to be the area that I've been patiently waiting for now for the last few weeks. And if we come down here, I'll be gladly picking up some shares for my long-term or selling some put options. 84 down to about 77 is the pocket that I will be targeting for any positions of that nature. At 90 bucks where we stand right now, you're currently at a mid-20s forward price to earnings, a 1.6 peg, and a very attractive free cash flow yield. So shave 10% more off this price. And that's where I really start to get interested on Uber overall. And last but not least, TSM up 1.6%, the good old bottleneck for NVIDIA, right? Will they be able to put out all the chips that NVIDIA will need? Well, TSM has been building a lot recently to expand their production facilities, but obviously that takes time. TSM told us that they had some nice price increases in the last few weeks, right? 5-10% per year for the next 4 years. So obviously they have a lot of things working for them, but daily downtrend right now. They did get some love in the after hours from NVIDIA. You'll notice this massive 3% push right there. So it's good, but if the job support comes in negative, well, you guys know the drill, right? We're sitting here in the after hours. Can you have just a lower high into possibly lower low? Absolutely. And that would just be further weekly downtrend consolidation. And as a result, further monthly consolidation. Now, where TSM becomes extremely attractive for me would be when the fundamentals and the technicals line up, which would be roughly around the 250 to 240 range. Every time it's come back and tested here, I've always been a big fan of buying. The last time was back here. You remember when I was saying it's pretty good. The 12 EMA is catching up to us. We've been consolidating for a while back here, like a month and a half, right? And it was looking pretty good right there. TSM is not a bad buy up here, but if you are buying, you have to be willing to kind of DCA into further monthly consolidation, as you will be getting a much better valuation. The valuation is not bad right now, but it's also not excessively cheap as it was previously at certain moments throughout the year. So TSM, still one of my favorite companies that I have in my long-term portfolio, but, you know, trading might just be choppy until we solve some of the macro issues that have been plaguing the market recently. So that's everything I had for you guys for the overall market rundown. Hopefully you enjoyed. Now let's dive into some of the biggest gainers and losers of the day, and I'll focus on some of the ones that I want to highlight rather than just running down this list in a kind of descending order, right? Okay, so let's take it from the top really quickly. So let's talk about BMNR and MicroStrategy, the treasury plays for crypto, guys. Well, obviously, you guys don't like crypto, do not play these at all. These should be only taken by people who have a long-term thesis, right? If you guys think that Tom Lee started this one or Michael Saylor started this one for a short-term thesis, that is not the case, right? Any shares that you are acquiring at these low levels, you should be willing to hold through the volatility for at least the next few quarters and the next few years as you go for the long-form crypto expansion. As a result, if you guys don't believe in crypto, well, you shouldn't even be playing Circle either, right? Trying to ascertain whether or not this is the bottom. It's so oversold right now. It's 70 bucks. The stock used to be 280 bucks, $300 almost, right? Don't do that, guys. It can always drop lower, especially some of these IPO plays or whatnot, as the RSUs come alive. Stock options come alive, insider selling, and possibly some pre-IPO people also sell into you. A lot of these IPOs, guys, look the exact same way. They'll have an initial pump, they'll dump for like 3 to 6 months, and then they will find a true floor. So in my opinion, a lot of you guys would just be better served if you just don't play any of this stuff, right? Especially if you just don't believe in it. Don't force yourself to take plays just because of how much they're down, just because you've heard of them or somewhere, right? Or you see people on social media playing them. Don't force yourself to play other people's convictions, right? Moving into all of the other names, right, which we'll talk about right now. Iris Energy, NBIS, you guys know all the ones I'm about to mention, right? CIFR, all that stuff, right? Whether it's the Bloom Energies, the EOSEs, whether it's the, the Navitases of this world, right? As I always say, guys, you got to play this stuff small and only if you have long-term conviction, because if you are playing these pullbacks and you have a short-term time horizon and you do not have daily uptrends overall, it's tough to say that these are local bottoms. Now, tomorrow you'll notice that a lot of these names will be up huge. If the job support comes in good, a lot of these names will be up huge, right? Do not chase these names with short-term call options, assuming that the lows are set and they will be moving higher. In my opinion, right, and this is a very stern opinion, you should not be playing these names unless you are willing to see the long-term thesis play out. You are going for the AI build-out, the AI expansion. So as a result, if you know that Navitas, that NBIS, that Iris Energy, CoreWeave, that other names in that whole niche, the AI niche, right? If you know that they're extremely volatile and that you struggle handling volatility, right? Then just don't play them. A lot of these names do not have daily uptrends yet. So if I see people FOMO into Iris Energy and get clipped by a lower high into lower low, and then, you complain about it on CoreWeave as well, or on something like an Iris Energy, right? And you wonder, well, I thought that was the bottom, right? No, you keep in mind who's in control here. The daily short-term bears are in control, the weekly short-term bears. We are embarking on large time frame pullbacks. These large time frame pullbacks take time to solve. So if you are buying shares, you should only be buying shares if you have a long-term thesis for AI. Everybody wants to make quick and fast money and call this the bottom, right? And call yourself long-term investors. But essentially, the only thing that you want is you want what people had back here. You want the quick, rapid, and fast gains that people were having at one point in history in this stock, right? That is the wrong psychological aspect to how you should be approaching these styles of names, right? It's fine to play them small. If you're trying to play the wheel on them, you need to be playing the wheel with extreme amounts of distance, right? And you cannot be chasing these after they're up 10% on a day with either short-term call options or things of that nature. I mean, you can if you want to, but so long as you understand where you should be, where you should have a stop loss level, or you should understand that you shouldn't be positioning very heavily into these names, right? These are long-term plays. They'll be extremely volatile all throughout. And definitely, guys, definitely, because we've gotten a few comments recently, right? You guys know who you are. I won't single anybody out. But to be honest with you guys, man, these names, you guys understand the risks, right? You understand the risks. There's no crying in the casino. I don't want to hear anybody else crying when they're playing the casino, right? It's not as if I'm telling you guys that these are the best companies in the world, that they're going to change the world, they're going to 3x overnight. No. They're going to be very volatile. If you cannot absorb the volatility, then you should not be playing them, man. People have different risk tolerances. People have different goals. People have different account sizes. So if you guys get caught underwater on some of these positions and you don't want to add to them anymore and you're just forced to hold them until they come back, you guys know I can't click the buttons for you, man. You click the buttons and there's no crying in the casino, all right? It's not as if these companies have proven business models, right? No, they're very big growth names with revenues far into the future. It's not like you're buying Amazon. It's not like you're buying Visa. It's not like you're buying Berkshire or companies of that nature, right? So no crying in the casino if you're playing these names, please, guys, right? So that is the whole thesis surrounding those names, because I'm pretty sure a lot of you guys will be asking about them overall. Additionally, if we take a look at some other names here, I mean, I guess I'll go to the names on the highs because we already covered most of these names in previous videos. 2 days ago, I also made a video of my top 20 stocks that I'll be looking for recently, which did include a few growth names such as Iris Energy, but small positions. A few growth names like Robinhood, which I do still believe are, attractive opportunities if we come back down here into the lower 100s to maybe start a position for a multi-year thesis. Not saying that this is the absolute bottom. Can it drop lower to 80? Yeah. But is 100 a nice area that I'd be looking to accumulate some shares to ride into the next 2-3 years? Not just wait for this immediate pump. Fully understanding that it could drop and stay down here for some time. Yes. Right? So there's always context behind a lot of the things that we talk about on the channel as well. Shopify as well is going to be very interesting. If we pull back down here, 130, 125, interesting location to kind of line up some technicals with some more decent fundamentals, at least a lot more decent than they were all the way up here at about 182. So there's a lot of interesting plays in the market right now. We've been highlighting them over the last few days. Just go back 2 days ago at the end of my video, I've pretty much derived a list of 20 stocks which I would be interested in playing overall. Matter of fact, I'll pull it up right now if you haven't seen the video. So they were these names right here. Some core names for a core portfolio, and then some growth names, which you're doing with a fraction of your portfolio. Some interesting names, but obviously for the prices, you'd have to go back to watch the other video. But this indeed was the list that we were talking about overall. So I'm going to leave it at that, guys. I don't want to give you guys too much in terms of, technicals on these stocks because, of course, they're going to move a lot with the jobs report overall. But just hopefully the psychology surrounding positioning, sizing, timing, things of that nature, right? These are the concepts that I want to teach you guys moving into the future. And just, you know, the barometer of setting expectations, right? Knowing what you're getting into. If you're getting into super volatile, super high beta names, and you're expecting to constantly be able to snipe the lows and then go on to a 50% rally and then sell the absolute top, right? You're joking, you're kidding yourselves, right? Don't get into that mentality. You always have to come into these trades with a thesis, either a trading thesis with a stop loss or a longer term thesis that you'll be able to kind of withstand some of the volatility swings. That's going to be it for today's video, guys. I don't want to give any more because tomorrow's jobs report is going to move the market in a pretty big fashion, in my opinion. So we'll just have to revisit some of these charts and some of these ideas tomorrow after we get more indications on the macro, which matters a lot in this environment. So hopefully you guys enjoyed today's video. If you did, consider dropping a like. Would really appreciate it for the growth of the channel. Consider subscribing if you're new as well. We'd love to have you back. And last but not least, if you have any questions, comments, constructive feedback, or anything in between, definitely feel free to leave it down below in the comment section. Always love reading your guys' comments, no matter which side of the aisle you are on, AI camp, non-AI camp, the market's a scam, we're about to go into a recession. Your opinion is always very valued, right? And very valid too. Those are just your ideas, your positioning, and everybody needs to do what's in their best interest for their own portfolio. I will never try and convince you guys one way or another. I'm just here to provide objective data, objective technicals, objective fundamentals, of course, and just ideas, right? Just ideas and concepts that will help you further along in your investing and trading journeys, respectively. So that's it for me, guys. Have a good evening. Take care. See you guys tomorrow. Good luck tomorrow and peace.